Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Finally get that breakout we've been looking for. Yeah, we got through that May high that we've been eluding us for so long. We tested it a couple of times. We've faded it several times. We've stayed away from it really since the end of May, and it hasn't even come really that close to seeing a significant breakout of that range. And lo and behold, today we did it. We saw 10-year note yields trade well through the old high, and currently sitting at around 316 are going to be well above the previous year-to-date high close of around 311. So right now we are seeing that breakout, technically speaking, and if you talk to anyone looking for a reversion trade, maybe back to the mean, we talked about 290 being kind of the level. 3% seems like a pretty good level at this point. So what used to be the old resistance, now new support, so to speak, and 10-year note yields themselves are sort of out there in no man's land, probably looking to extend, but not too far. Don't forget, all those hedge funds are still short, and they may look to cover if we get a move closer to 320. And if you look at implied volatility, we talk about volatility. It's kind of one of those things where when it goes up very slowly. When it goes down very quickly. And when we see breakout moves outside of expectations, outside of the range, outside of the norm, that's when we start to see a bid. And while we did see volatility bid today, it really only got back to those pre-FOMC levels that we saw last week. And I think that right now the market may be looking to sustain that move, at least as long as we stay up here and as long as the market continues to sell off and yields continue to go higher, because the further away from the norm we get, the higher volatility should get. So right now, volatility is higher, yes, but it isn't significantly higher to cause any real pain. That being said, it could continue higher as yields go higher as well. And lastly, the fuel behind the breakout. Yeah, the ADP number came out this morning, the private employment numbers, which were well through expectations, and that sort of got the ball rolling. Let's not forget that Chairman Powell has been speaking recently, reiterating his fact that they want to continue to raise rates, they want to continue to see monetary policy tighten, they want to continue to unwind the balance sheet, and all of this regardless really of what happens in the periphery when mentioning geopolitical risks, when mentioning economic risks, credit risks. The Fed is on its path, and the U.S. engine that is moving right along. So I think that right now Chairman Powell's job is more to keep his hands off the wheel and let the market go, and that's exactly what he's doing. And I think that tighter Fed policy, higher rates, and much stronger employment that doesn't include any kind of hiccups in inflation are going to be very welcomed by the Fed at this point, especially if the equity markets continue to do what they're doing, and that's hanging on those all-time highs. So right now the bond market seeing a turn, new year-to-date highs in the 10-year note Treasury yield. Will that continue? A big number on Friday could change all that, but it's likely to be strong based on today's ADP. This is Todd Colvin coming to you from the floor of the CME Group.